All right. So, yeah, and also just feel free to drop in any questions that you guys have that you want me to answer. I'll start kind of just going through what I had in my mind, but uh, mostly want to make sure that I'm being beneficial to everyone that's tuning in today. So, drop your questions, and I will, like I said, do my best to kind of field those. So, in yesterday's call, and by the way, when I'm looking over to the right a little bit, it's just because I've got notes on the other screen that I'm trying to track. And so yesterday, I kind of went through the framework that this equation that I have, which is really something I ripped off from this guy named Chip Conley. He came up with the initial equation, which said anxiety equals uncertainty times powerlessness. And so I think it's the distributive property that says I can just add financial to that. So financial anxiety equals financial uncertainty times financial powerlessness. And that just feels right to me. That really struck me when I heard that equation initially. And I've always been kind of particularly interested in how do we help people obtain financial certainty, because I think that's what we're all ultimately seeking, whether we're in good times or bad times, is this being able to answer the question, am I going to be okay? So if we buy into the question, we buy into the equation that financial anxiety equals financial uncertainty times financial powerlessness, then really what we want to do is increase our certainty and increase the power that we have over our finances. And so there's some methodologies for how we go about doing that. I have a whole framework on cash flow engineering, which is really about systematically aligning your cash flows with your priorities. Using a framework with I'm a big fan of cheesy acronyms, as you may know if you've been following me or any of my content at all. But I came up with this acronym, or maybe it's a mnemonic, called CASE, which is compile, assess, strategize, and execute, which is really the framework that we should follow to kind of systematically evaluate our cash flows, and ideally identify any hidden assets that we have and optimize for our intended outcomes. And so really the whole cash flow engineering process, well, it has the word cash flow in it. It's really strategy. It's not finance stuff. A lot of people just say they hate finance stuff. But finance is really about managing money. Accounting is really about documenting what happened. But ultimately, this all the finance stuff, all the accounting stuff is the output of decisions that you've already made. And so really, to me, when I think about the whole cash flow engineering, it's about strategy. And so we can use the whole systematic engineering process to help drive up our certainty. And then to drive up the power side of things, we use some principles for decision making, and we use the way we set up our bank accounts and reserves to give us more power. And then there's also something around readiness, or understanding the rhythm of our business. And that sort of is in combination the way that we go about trying to drive up or reduce our anxiety, excuse me. So I'll touch on some of those things today, but there are some specific questions that I know that I've received via email. Probably the most common question that I've been getting with folks is around tax due dates. So yesterday was a deadline for filing partnership returns and S-Corp returns. Those did not get extended. We thought they might, but those dates didn't get extended. So if you haven't filed those returns, hopefully you filed an extension. There's really usually no tax due with, at least at the federal level, with your S-Corp or partnership return. So really the big date is April 15th, where we've got C corporation returns and individual returns are really that's where the tax due is. So to give you kind of an update on that, we got an email from the AICPA, the American Institute of Certified Public Accountants. So basically the national group for CPAs that really do a lot of lobbying, frankly, on our behalf as CPAs. And they've been pushing hard with the Department of Treasury and with the IRS to get the due date pushed out. And over the weekend, the email said, the email that we got was that we're expecting an announcement any day now that the Department of Treasury and IRS is going to push out the due date up to 90 days. So 90 days from April 15th. So that's the expectation from the AICPA. At this point, nothing is final. My expectation on all of that is that we're waiting for the most recent bill that was passed by the House on Friday to get approved by the Senate and signed off on by the President. So I think that shoe has to drop first. And it sounds like there's been some proposed changes from the Senate and some requests from the President in terms of updates to the initial bill. So I think that shoe has to drop first before we will get an announcement on an extension of the due date for the tax returns. So right now there's nothing official, but I'm expecting that we'll have some clarity on that by the end of this week. Things are moving really quickly, as I think you guys probably all know. So hopefully we'll get an answer soon. But the recommendation that I have for everyone is certainly if you think you're due a refund, get your return done ASAP. In the past, when we've had these financial constraints, or when we had the last big overhaul of the tax code a couple years ago, there were relatively significant delays in terms of people getting their refunds processed, simply because the IRS is pretty resource constrained in general. And so if you have a refund, get that in ASAP, so you can get some certainty in terms of the deposit in your account. If you're not sure about a refund, get your return prepared. Doesn't mean you have to file it, but get it prepared so you know exactly how much is due. And then depending on that balance and where you're at in the overall picture, then you can make an informed decision about whether or not you're going to file. But I think getting clarity on those balances due as soon as possible is key in the current climate. So I guess to summarize, for those of you who are just jumping on, expecting based off the AICPA that we should hear sometime this week an extension on the April 15th due date. I think the shoe that needs to drop first is this current proposed bill that needs to get finalized, and that probably will happen in the next day or two. So once that happens, that's when I'm expecting an announcement on the extension of the due date. But regardless, I think certainty is probably of the highest order. So if you got a refund, lock in that refund. If you're not sure, get your return done, find out what you owe. Doesn't mean you have to file, because the extension that's been floated, or at least what the CPA is expecting, is that it won't just be an extension on the due date, but there'll be an extension in terms of having to pay taxes free of penalty and interest. So let's get some clarity on that. So that's been the main question I've had out there. Let me know if you guys have any questions about that or any other questions in general. Happy to tackle them. Chandler says, general question, would love your take on developing new cash flow strategies. Saw you released a new program on kids' financial literacy. How best to develop new offers in uncertain times. So let me pull up my notes really quick on that. Because I have a methodology for developing new offers. So I'll get that pulled up in a moment. But as a prefacing remark, so to answering that question, I mentioned that we want, for addressing uncertainty in the equation, financial anxiety equals uncertainty times financial powerlessness, we utilize cash flow engineering methodology to increase our certainty. Tax strategies, tax planning helps there as well. And then we have the power, getting more power over our finances. And where I see people losing power over their finances is that they don't have a methodology, frankly, for how they process issues. It's often kind of scattershot. And so they're using different frameworks, or maybe they read a new book that they thought was interesting, and now they're utilizing those new methodologies and how they're making decisions. And there's this ongoing iteration in terms of the methodologies and thought processes and so on and so forth. And I don't want to suggest that I'm opposed to ongoing learning. I'd like to believe that I'm a lifetime learner and very, very curious, but being very mindful of anytime you change your methodology, you just introduce new risk into your business, and you have less comparability from the current period to the previous period because you've changed the way that you've processed issues. And so we need to be at least mindful of or aware of how we're processing issues, and are we doing something new? I always think about it, and if you don't know, my background is in derivatives, hedging. I think a lot about how do I eliminate the downside. And so ideally what we're doing is we're growing our cash flow while simultaneously reducing our risk. And oftentimes what I see, and I've given lots of examples in previous Q&As in the weekly process, is that in order for folks to grow their cash flow, they've actually taken on an additional amount of risk, such that their risk is growing at a rate that's faster than their cash flow. And so you find yourself in this constant hyper state of you can't really relax, take any time off, frankly, because you've added all this risk that maybe you're not, maybe you can't name, but you're subconsciously aware of. And so we want to systematically drive down risk while increasing our cash flow. So I use principles. And the first principle that I go back to time and time again is, first we optimize, then we maximize. This is the principle that I use, frankly, the most often. And I see we've got a lot of new faces in here, so that aren't part of the kind of weekly calls that I do. And so I'll just give you a background on this whole notion of first we optimize, then we maximize. So again, my background, derivatives, got an accounting degree, worked for the board that writes all the accounting standards, worked for one of the big global firms, Deloitte. And so my background, I'm mentioning that mostly just to say that prior to starting its degree, my background was really working in Fortune 500 businesses or related activities. And so all my formal education is really around this idea of maximizing shareholder value. So corporations are built to maximize shareholder value. Well, what does maximize mean? Maximize means having the most today. And when you're a big corporation, you can do that. You can maximize because you have a huge team. And I think back to an example I think about often, which is my wife used to work in corporate recruiting at Starbucks. And she had a team that was focused specifically on recruiting for their design team, so like designing the stores. And so there was a team of people who were just focused on recruiting for designers, and then within that team was a team of a couple people who were solely responsible for managing the software that her team was using to recruit the designers. So they had a couple people who were just managing the software. And so the point is, these big corporations, they have so many different levels, so many different teams, and they're able to have a person or a couple people just managing one software, or maybe a team of people managing one software. So they have all these resources. And so while each individual may say that they're pulled in a lot of different directions, really they're focused on kind of one line item of a huge profit and loss statement, or maybe even a sub-line item. And so they're really able to maximize, they're able to focus on trying to have the most today. Well, the reality is as a business owner or an individual trying to navigate your finances, is that you don't have this massive team of folks. You're wearing several different hats. Most of the business owners I talk to, when we go through this exercise of like drawing out your org chart, utilizing not the people you have within your team, but just the roles and the things that you're doing, we end up finding that each business owner is wearing somewhere between 12 and 15 different hats, from being the HR director to the head of marketing to the head of sales, so on and so forth. And so all that to say, you don't have the resources, both in terms of staff or in terms of time, to be able to maximize. So that means you have to optimize. Optimize is about finding the most efficient path forward, given your priorities, given what you want. And so the way that I see maximizing manifest in the decisions that people are making on a day-to-day basis, and it becomes paralyzing, is questions around, well, should I sell my, I've got employee stock, I've got an employee stock purchase program, so I've got a bunch of stock, and I've got these retired IRAs. what do I do? And how do you answer that question, right? Because you need more context. And so my process is, well, what are you actually optimizing for? What are your priorities? Let's rank them in sequential order. Let's assign a dollar value to them. And then you need to optimize for the priority number one first, and allocate your resources to funding that first, and then you work your way down. And so then that solves the problem of, well, if you have all this employee stock purchase, the stock from an employee stock purchase program, or you have an IRA, and really what you want is to fund your, you want to have 10 more hours per week, or you want to invest in real estate. That's a common thing that I get. I want to invest in real estate. Well, rather than worrying about short-term versus long-term capital gains rates, and is the stock going to go up or not, if you're optimizing for being able to invest in real estate because you want passive income, and then under the optimized framework that's the action that we take. We sell the stock, we pull the funds out of the retired IRA or inherited IRA, and we allocate those towards our first priority. Now, what happens when people go through that process is that they realize that that's not actually what they want to do. And so you vote with your money. Anytime you actually have to take action and spend, that's what I call voting with your money. And it helps reveal what your actual first priority is. Because oftentimes folks, you go through that initial exercise of what you think is number one, number two, so on and so forth. And oftentimes when we get to the place of, okay, we're going to optimize, which means we're going to sell this stock and we're going to fund this priority, people go, I don't want to do that. Actually, my number one priority is something totally different. And so it gives you a lot of clarity in that moment as well about what you really want, what you really care about. And so that's the first. We optimize, then we maximize. So it comes up a lot, but really whenever you find yourself trying to do several things at once, trying to fund everything, trying to maximize the value of every single thing that you own, trying to build out all these elaborate spreadsheets, and then you get to the end of it, you can't really glean what the next action step is. That's because you're maximizing. You don't have the resources, time, access to the data to really do that. You need to flip to optimize what's the most efficient path forward. Let me know if that resonates with you. It comes up a lot in my business where I find myself with a bunch of different competing priorities. I'm trying to do all of them at once. Really, I need to be optimizing towards what's the most efficient path forward. The next priority that I use the most often is hedging downside risk. So just to give you a practical example is this whole coronavirus thing. We woke up here in Seattle a couple Saturdays back, and the news to, unfortunately, a couple people passing away. And immediately where my head goes to is, what are all the downside risks that we face? And the biggest downside risk that I could see in the short term was, are we going to be able to work? Are we going to go into a lockdown similar to, at the time, I think just China and South Korea were in a lockdown. So are we going to be able to get the work done? And am I going to keep my team, staff and family healthy? And so we work through all the downside risks. And so we made the decision, let's move to remote now so that we can test things before it's too late. And so we've taken a bunch of other actions since then, but getting real clarity, and this isn't necessarily a fun thing to do, but getting real clarity on what are all the downside risks that you face in your business and personally. One of the other things that we did was, one of the downsides is access to childcare. And so my wife immediately texted one of the teachers at our youngest daughter's daycare and just said, hey, in the event the daycare closes, and depending on where we're at with the lockdown and everything, could we hire you to nanny for our kids for a while? And so we got that agreement now in the event that we didn't want to be, in the event that the worst case scenario happened and we needed childcare and all the schools were closed. So getting real clarity on what are all the downside risks. Again, this isn't necessarily a fun thing to do, but it does reveal challenges that you can get ahead of right now. It also dovetails into when I've talked to folks about recession proofing, is that ideally what you have is, and it's along the same lines as this whole hedging downside risk, is I call it a plus minus list. But basically, what are the things that you want to buy when they're on a discount? Because the reality is there's stuff on discount right now. I've seen it a bunch of different emails about gift cards that I can buy and discount, but also, unfortunately, there's going to be resources, people, and softwares, and so on and so forth that that are going to go on discount, and maybe access to talent that you couldn't have otherwise hired in the past. And so having a list of that now in sequential order, so that you don't get shiny object syndrome and start just buying things because, oh, that sounds fun. I like going to this restaurant, so I'm going to buy this thing that's on discount now. Where is that actually on your list? So rank order them and buy from the top down, but also having your minus list. What are the things that you're going to cut, and having an honest conversation about, well, if I would cut them, if I was very quick to add them to the cut list, why wouldn't I not just do that now? I don't know if you guys have heard me talk about, again, I see a lot of new faces in here, the whole idea of naming the puppy. So when you go to the pound, you see a puppy, you give it a name, chances are that's now your puppy. You're not going to leave the pound without the puppy you just gave a name to. And so we have all these things in our life that are puppies that we've named, that we've built up some attachment to. And so it's important to have this list of what are you going to cut. And if you're quick to add something to the list, then that might be an indicator that you didn't need it to begin with. And it's just a puppy that you're holding on to. But also there are other things that are going to be on the list that you can't just so easily cut. And so making sure you've got clarity on when the trigger point is for when you'll have to take that action, I think, is key. So just to summarize, these are examples of principles that I use. One is first we optimize, then we maximize, and trying to be aware of when am I trying to maximize when really I can't. And then hedging downside risk, getting real clear on what are all the risks, how can I eliminate them. That plays into building out kind of a plus minus list. What are the things I'm going to add? What are the things that when they go on discount in order, what are the things that I'm going to cut? And what are the trigger points on those? Another principle that I wanted to mention that I think is really relevant right now is this concept of T-learning versus I-learning. And this really comes primarily from the computer science domain, but T-learning is this idea that you can pull from multiple different domains and apply it to your subject area or your area of expertise, whereas I-learning is just focused on one specific domain. So for example, if I was trying to solve an issue with my accounting firm, I could go out and just research accounting firms and find out all the best practices of what accounting firms are doing and try to implement that. Alternatively, I could look out to what are other industries doing, what are things in natural law that exist. I can take those issues and then I can apply it to my specific industry or problem set. And so one is easier than the other. T-learning, the T-learning application is much easier for problem solving because chances are you already have these ideas, these notions about the way that things work, or that you have more access to the information than going out and trying to survey every accounting firm that's out there. So I bias T-learning over I-learning, meaning I'd rather go out to other industries, natural law, et cetera, to try to solve a problem first. And so as you're working through issues, maybe within your business or within your personal life, you may have this inclination to go, I need to just drill down on my specific domain. This is a finance issue, so I'm just going to look at finance, when in actuality you may have the answer from elsewhere. So it tends to be a hack for problem solving. So I wanted to share those principles. I have 10 core principles that I use, and I'll share others in upcoming days. But we've got about 4 minutes left or so, and I wanted to actually answer the question around how do you develop new offers or new ideas. Part of it is T-learning, and part of it is a specific methodology that I've used, which again, I try to develop these principles because it gives me more power over the decision-making process. And so for any new thing that I want to do, first there's a hard pause on doing it because I know by doing something new, I'm creating risk. And absent a preponderance of data to suggest otherwise, I have no idea what the sales are going to be. There's just a lot of speculation about what the outcomes might actually be. And we may go out and do a bunch of market research and all of that, but at the end of the day, it's speculation, it's gambling, really. I think a lot of what we do in our personal financial life and a lot of what we do in our business is gambling. We just don't call it that. And so I'm trying to create these guardrails to force me to make the right decision. Yesterday, I talked about all the cognitive biases that we're subject to. And so I use these 4 lenses. And I have to be able to say yes to 2 of them to be able to proceed. And so is this thing that I'm doing going to be a forcing function? Is it going to result in some time savings? And those are qualitative, or somewhat intuited those. So it's hard to find data to confirm that it will be a forcing function or say universally that it will be a time savings. So somewhat qualitative, or and then will it be revenue generating or an expense reduction? And so for me to be able to proceed with something new, I need to be able to check the box on at least 2 of those. And in particular, I want to have a preponderance of data to say that I have a reasonable basis that it will be revenue generating, or reasonable basis that it will be an expense reduction. So I have all these ideas that come up, and I will go through this exercise where I go, how much data do I have to support that this will be revenue generating? Maybe not a lot. Okay, so I can't really check that box yet. Will there be any associated expense reduction? Maybe I can get a lot more clarity on that. So maybe I can check that box. Now I only have 1 box. So will it be a forcing function or a time savings at some point? So forcing function is, just as a really crude example, but we've been set up to be able to do remote work as a team for 3 years, and the team has been asking for it, but we've kind of said, no, we want you in the office. Well, this coronavirus was unfortunately a forcing function to go, let's go remote. And we got to test the system before we're required to do it. So forcing function is really, by virtue of committing to this thing, or this event has happened, it forces this other outcome, or forces you to do something that you want or need to do. Sending an email about an offer and getting clients to sign up and pay you now becomes a forcing function. Now you have to take action. Time savings, that's hopefully more clear. Is it ultimately going to save you time now or in the future, or your team now in the future? So I apply those lenses. Will it be a forcing function? Will it be a time savings? Those are more qualitative. I can't say definitively, usually. And do I have data to suggest that it's revenue generating or an expense reduction? So need to be able to check at least 2 of the 4 boxes to proceed. If I have several different opportunities that I'm facing, all of which I can check 2 or more boxes on, then I'm going to rank order based off magnitude. So how certain am I about each of the boxes that I've checked, and how revenue generating will it be, or how much of an expense reduction will it be? And then I'm just going to bias towards the one that has the biggest impact first, down. Knowing back to optimize versus maximize that I can only do 1 at a time. If I try to do several of them at once, now I'm back to maximizing, and we're violating our own principles. So that's sort of how that works. Chandler, is that helpful in terms of answering your question? I'll see if you're still signed in. I guess looks like you're still here. Cool. So we're right at time. Thanks for everyone that showed up. Basically, I'm just doing this every day, Monday through Friday, sharing my principles, methodologies, ways that I'm trying to unpack and create certainty in my business, my life, and for hopefully you guys, in ways that we can use these principles and decision making such that we're arriving at an outcome that's really going to help us get back to our priorities. I want to leave you with one thing, which is, go and take a look at how long these pandemics last. And at least according to some folks that I've listened to, and I'm getting my data from Johns Hopkins, is that typically it's the 3 months, and that at the midpoint is really where we're at the peak, and then we start to level off. And on occasion, historically, there had been a second wave, and then it can become endemic, meaning it's an ongoing issue. But really, it's typically 3 months from when it becomes officially a pandemic. And so what we're looking at right now is, if you use historical data, we got kind of 3 months. And so how do we go about kind of rigging the game to win so that we're in the right situation to really do well coming out of this 3 month period of time? And so it's not ideal that it's 3 months. Yeah, it could be longer historically. And when I run my equations and things based off the data that I'm looking at, not that I'm not an epidemiologist, I'm not a virologist, obviously, but when I look at the data, the historical stuff, it's a 3 month period. Unfortunately, the way that this stuff works is that the data is a lagging indicator. So we won't know we've hit peak until we're a week or two after peak. So we're going to probably peak out somewhere around mid to late April, but we won't know that until 1 to 2 weeks later. The data is lagging. So relevance of that is that gives you more certainty about the state of things and making decisions accordingly. There's no guarantee of that, but historical evidence suggests we're really looking at kind of this 3 month period of time. I hope it's less than that. Hope I'm wrong, but I would plan accordingly. Hopefully that's helpful to you, and hopefully I'll see many of you tomorrow. Appreciate it.